Financial markets and credit ratings. An overview of market dynamics and credit evaluation. Agenda: over the counter market, spot market, forward market, credit ratings, speculative grade and investment grade, default and its implications. Over the counter OTC market, less regulation. The OTC market is less regulated than traditional exchanges, offering more flexibility in trading. Variety of instruments. The OTC market accommodates a wide range of financial instruments, allowing for diverse trading options. Customized contracts. OTC markets facilitate customized contracts and agreements tailored to the needs of the involved parties. Types of instruments traded. Stocks. Stocks represent ownership in a company and are commonly traded in the OTC market, allowing for flexibility in trading. Bonds. Bonds are debt securities issued by corporations or governments, frequently traded on the OTC market for their unique terms. Derivatives. Derivatives are financial contracts whose value depends on the price of underlying assets, often traded OTC for tailored strategies. Foreign exchange. Foreign exchange involves trading currencies and is a significant part of the OTC markets, providing liquidity and flexibility. Advantages and disadvantages. Advantages of OTC market. The OTC market provides flexibility, allowing traders to negotiate directly and tailor contracts to their needs. Lower transaction costs. Transaction costs in the OTC market are typically lower compared to traditional exchanges, making it more cost effective for traders. Disadvantages of OTC market. Despite its advantages, the OTC market poses risks such as less transparency and higher counterparty risk. Spot market. Immediate transactions. In the spot market, transactions are settled immediately, providing instant access to assets and liquidity. Real-time pricing. Spot markets feature real-time pricing, allowing participants to make informed decisions based on current market values. Direct ownership transfer. Ownership of the asset is transferred directly to the buyer at the time of the transaction, ensuring clear title. Spot market transactions. Types of spot markets. Spot market transactions can involve various financial assets, including commodities, currencies, and securities. Price determination. In spot markets, prices are determined by the dynamics of supply and demand, reflecting real-time market conditions. Market reflection. Spot market prices provide a clear and immediate reflection of current market conditions and trends. Role in the financial system. Maintaining liquidity. The spot market plays a vital role in ensuring liquidity within the financial system, facilitating quick transactions. Quick transactions. Investors can swiftly buy or sell assets in the spot market, responding to market changes effectively. Hedging against fluctuations. The spot market allows investors to hedge against price fluctuations, providing a risk management tool. Forward markets. What are forward contracts? Forward contracts are customized agreements to exchange an asset at a specified future date, providing flexibility for both parties. Risk management. These contracts play a significant role in risk management by allowing parties to lock in prices and reduce uncertainty. Price stabilization. Forward contracts help stabilize prices in volatile markets, ensuring predictable costs for businesses and consumers. Forward contracts and their uses. Definition of forward contracts. Forward contracts are agreements to buy or sell assets at a predetermined price on a specified future date. Price lock-in mechanism. These contracts allow businesses to lock in prices, providing stability in budgeting and planning against market fluctuations. Risk mitigation. Forward contracts help mitigate risks associated with price volatility, benefiting companies in various industries. Comparison with future market. Nature of contracts. Futures contracts are standardized and traded on exchanges, while forward contracts are private agreements tailored to specific needs. Flexibility. Forward contracts offer greater flexibility in terms of conditions compared to future contracts, which follow strict regulations. Counterparty risk. Forward contracts introduce counterparty risk since they are not traded on exchanges, unlike futures contracts, which have clearinghouses. Credit ratings, speculative grade, and investment grade. Understanding credit ratings. Definition of credit ratings. Credit ratings evaluate a borrower's ability to repay debt, serving as a critical metric for lenders and investors. Impact on interest rates. Credit ratings directly influence interest rates, determining the cost of borrowing for individuals and businesses. Investment strategies. Investors use credit ratings to assess risk levels associated with borrowers, guiding their investment decisions and strategies. Criteria for investment grade ratings. Lower credit risk. Investment grade ratings significantly lower credit risk, indicating a more reliable financial investment for investors. Financial health assessment. These ratings are assigned based on thorough assessment of an entity's financial health and performance metrics. Attracting institutional investors. Investment grade ratings are crucial for attracting institutional investors who stable and secure investments. Characteristics of speculative grade ratings. Higher credit risk. Speculative grade ratings indicate that there is a higher credit risk associated with a rated entity, reflecting potential financial instability. Financial difficulties. Entities with speculative ratings may face financial difficulties, influencing their ability to meet obligations and affecting investor confidence. Higher yields for investors. Investors may receive higher yields when investing in speculative grade rated entities, compensating for the increased risk involved. Definition of default. What is default? Default refers to the failure to meet debt payment obligations, which can include both principal and interest payments. Consequences of default. Defaulting on debt can lead to severe legal actions and significant financial repercussions, affecting credit scores and future borrowing. Causes and consequences of default. Economic downturns. Economic downturns can lead to increased unemployment and reduced incomes, making it harder for individuals to meet financial obligations. Poor financial management. Ineffective budgeting and financial decisions can result in overspending and inability to pay debts, leading to default. Unexpected expenses. Sudden and unforeseen costs such as medical emergencies or major repairs can strain finances and lead to default. Consequences of default. Defaults can result in severe consequences, including loss of credit access, legal actions, and bankruptcy filings. Managing default risk. Assessing borrower creditworthiness. Evaluating the creditworthiness of borrowers is crucial in managing default risk. This assessment helps in making informed lending decisions. Diversifying investments. Diversification of investments across various asset classes can significantly reduce the risk of default in a portfolio. Using financial derivatives. Financial derivatives can be utilized as hedging tools to manage default risk and protect investment portfolios. Conclusion. Importance of financial knowledge. Understanding financial markets is essential for making informed investment decisions and managing financial risks effectively. Role of credit ratings. Credit ratings provide crucial information on the creditworthiness of entities, guiding investors in their decision-making process. Navigating financial landscape. A strong grasp of financial concepts helps professionals navigate the complexities of the financial landscape with confidence.